SEBI's fund classification system has standardized fund categories, but it has not simplified the job of picking up the right one. This issue and other issues related with it will be discussed in today's Investors Hangout, brought to you by Aditya Birla Sun Life Mutual Funds and Value Research. To address these issues, we have Dhirendra Kumar, CEO of Value Research, with us. Dhirendra, we welcome you.
Thank you.
There are 36 official categories to choose from, and fund selection remains a daunting task as ever. How do we handle this?
Yes, there are 36 categories, and I think, it's not just 36 categories. Within these categories, you can have multiple thematic funds, you can have multiple sector funds, and then beyond this, you can have all kind of closed-end fund, because that is not in the purview, because the classification system applies only to the open-end fund. And besides that, you can have a wide array of ETFs and index funds. So, it's just not 36. It's possible to actually have, a fund company can legitimately have within this classification system 60, 70 open-end funds.
Okay.
And they can have as many closed-end funds as they want to. Fixed maturity plans and others, so a fund company can well have, many funds. Investors need to be very careful about, what they need. Fund companies will have, this has been organized. This reclassification system is a good step, because this does one thing very clearly, that a fund which has, earlier the mandates were very flexible. Fund companies were not organizing, equity diversified. Every fund started with a mandate that they will be investing in equity for long-term capital appreciation. Yeah. Then came the final classification that they will be investing in smaller companies, mid-sized companies, or they will be investing all over. They'll be investing in high-growth companies. They'll be investing in companies which are relatively cheaper, yielding higher dividend, and so on and so forth. Different strategies embedded, and they were pretty vague. A fund could actually go anywhere. Likewise, fixed income needed a much more finer. Of course, it is way too finer now. I would have liked that there were fewer fixed income fund categories. But nevertheless, we exactly know how a fund will behave from here on.
Okay.
A fund which now states that it is going to be a large cap fund, it has to necessarily invest 80% of the money in top 100 companies. When a fund is saying that it's a mid cap and small cap, so the definitions are very clearly defined. Likewise for the fixed income fund. So now you can choose your fund with the understanding that this is how this fund will behave. There will be a predictability of expectation. Earlier, a fund could have started as a mid cap fund, would have gone on to become a value fund. Correct. And then if it would have turned big, maybe by forced to become a large cap fund, because that was the only way out for the fund.
So it's not going to be a namesake fund. It's going to be something that whatever it is saying,
defined,
it has to
do. So what in computing is said is what you see is what you get.
Yeah.
What you will what is being said is what you will get at all times. Then comes there are too many kind of funds available in a structured format. Most investors can ignore most, because what you need is a good equity fund, a diversified equity fund for your long-term money. You need, if you're getting started, conservative investor should be considering a balanced fund or a hybrid equity fund. So you can actually now look at 4 or 5 categories that will fulfill most of your needs. Money for few days, consider long-term, short, liquid fund, and the short duration funds. So 3-4, and for your tax saving needs and long-term investment, just have a set of multi-cap fund, and that will do your job. So if an investor is looking at his needs, 5-6 kind of funds will do all your job.
Okay.
You can do with that, and you can clearly you can well afford to ignore the rest, and you can focus on these 3-4 needs: money for many years, money for conservative investor, and short term and immediate term, short term parking avenue. 5-6 kind of funds will actually do your job, fulfill most of your needs, and rest of them you can safely ignore, and you will not miss out on anything meaningful.
Okay, what are the aggressive hybrid funds that you were mentioning a while back? Are they now replacing the balanced funds?
Yeah, they are the erstwhile balanced fund.
Yes.
Balanced funds were actually not balanced for a long time. So, they were 65, 70, 75% into equity. So now they have been renamed as aggressive equity fund. The erstwhile balanced funds are now aggressive hybrid funds.
Okay.
And there was no large balanced fund category. Now there is a very well defined balanced fund category which is balanced. 50% equity, 50% debt, plus minus 10%. So even a balanced fund will be a good way to start for people, but aggressive hybrid will be a reasonably growth oriented conservative vehicle for your long term investment.
All right. So we have tax saving and multi-cap funds if we want to go long term, and we have aggressive hybrid funds if we are the first time investor. And then we have liquid and short duration debt funds if you are wanting to invest for a short period of time.
Yeah, for when you need the money in 3-4 years, predictability of return, you don't want to take any significant downside risk. Fixed income funds are for you. And
so these are the 4 funds that we have talked about. What about the other 30 to 32 funds of the categories that are left?
Those are meant for active investors, nuanced. No,
am I to be confused with these?
No, I have been advocating for a long time that most investors should simplify their understanding and their strategy of investing. Keeping it simple helps. And I don't think a normal common investor, individual investor will be compromising on any big opportunity. Once in a while you will have, you have these dynamic funds and the credit risk fund and the arbitrage fund. These are meant for people who are looking at things tactically for the short run. If you are looking at, there are 2 categories which are very clearly specified by SEBI, which is, the solution oriented for investing for children and investing for retirement. But our view at Value Research has been that any investment is meant for retirement if you are actually investing for your retirement. Multi-cap fund is your retirement fund. Any multi-cap fund is a retirement fund. You don't have to necessarily worry about it. This is a classification system which has been done by SEBI to bring some order to the kind of funds that are supplied by the fund industry. But you can well do without it. Any open-end fund where you start investing for retirement or you start investing for your children's needs, that's your children's fund. You don't necessarily need a label for that. Maybe there is a marketing imperative to this, that people, there are a lot of investors who are financially not sophisticated, they don't understand it. Maybe their expectation is that if it's a children's fund, then it's good for children. It may not be. The simple principle that you have to follow is that if your child is too young and you're investing for many, many years, 10 years, 15 years, invest in equity. As you get closer to your goal, move your money to fixed income and do it gradually. All these things should happen gradually. And any fund could be a good fund. In fact, you should be choosing the best funds of the generic kind for these needs. So there are 36 kind of funds, 32 kind of funds, and all kind of hybrid fund. And beyond this, as I said, that there could be many index fund, sector fund, thematic fund. They are meant for people who are trying to dabble on something. When you are looking at an infrastructure fund or a consumer fund or something, it is only violating the principle of the reason why you buy a mutual fund, diversification, instant diversification. It's a compromise on diversification. Unless you find a compelling reason not to get to get after it, for a specific expectation or for a specific understanding, you should avoid that.
Okay, and I guess this 5-year lock-in period that they have specified for the solution-oriented funds, which you mentioned, is perhaps to encourage people not to withdraw that kind of money.
Yeah, that could be useful for many people, but I just wonder that the investors should be disciplined about their investments.
In any way.
Of course, there is a problematic thing that when you are faced with the market turbulence, many investors get are anxious, or they get shaken, or they are driven out of the market. But choosing a good fund, investing regularly for whatever goal, and sticking to that action plan that you have crafted, devised for yourself. That's the simplest and the easiest way of achieving. And then your range of selection, you are able to choose the finest of the lot. In India, we are still going to have a long time before active investment becomes, comes under question. So active, where a fund manager is taking a call and adding value and is able to generate substantially higher return than benchmark. More so with your regular investing, where an investor with his discipline is able to earn more return by averaging his investment in a turbulent market like India. So choose the finest of the generic kind. Stick to that. That is meant for naive investors who are not disciplined. They don't know much. They get scared by the market, and they are not going to be regular, and they don't want to understand. Maybe for them it might be useful.
Okay. Then what about the investors whose funds have merged into another, and how will it be taxed if somebody exits that funds now?
Oh, this was taken care of in the Union Budget 3 years ago, where the fund merger is not treated as a new investment. This has been thrust upon by somebody else's action. Earlier, the situation was that 3 years back, a fund merger was treated as redemption of a fund and purchase of a new fund. No longer. Your initial date of investment is considered as your date of purchase, and if you have held it for over 1 year, it will be considered as long-term capital gains. Moreover, with this long-term capital gains tax of 10%, all your gains till January 31st, 2018 is tax exempt. So only your gains subsequent to that will be taxable. So there is no tax implication of a fund merger. There is an implication in terms of, a lot of funds have changed their objective. A fund merging with a similar kind, I don't think investors need to worry. There are funds where there has been a fundamental, there is change in the fundamental attribute. A fund which was a balanced fund and now it has become a balanced advantage fund, or a fund which was an equity fund which has now become a balanced fund, or a fund, which was a multi-asset fund, now it has become something else, an equity income fund, or a dynamic fund which was perceived to be an all equity fund has become something else, or arbitrage fund becoming a equity income fund. So those kind of things, in those cases we have disbanded our rating, where we are treating those funds, and in all there are only about 18 funds, where equity funds and hybrid funds, where there has been a change in the fundamental attribute. Earlier it was a different kind of fund, from now on it will be a different kind of fund post classification. So we are looking at those funds, and value research rates those funds only after they have 3-year history of managing with the same mandate. So once they get 3 years older, they will be rated again. So investors will come across a situation that
as unrated for 3 years.
That is why for now the rating has been disbanded. They are unrated, and they have to now build a history of the way they will be managing the money from here on to be rated again.
If you were to tell our viewers about 3-4 points to take care of now that they are investing, of course, let's leave aside that they all have to invest regularly and they have to be disciplined on. But what about these categories? Anything that you want our viewers to know that they need to take care of?
No, you don't need to take care of. If you're following all the principles which you think is routine, that invest regularly, invest your long-term money and appropriate kind of fund. Beyond that, there's a good payoff here, that your fund will remain exactly the way it is. When you are investing in a multi-cap fund, it will remain a multi-cap fund. If you have chosen to invest in a small cap fund, it will remain a small cap fund. So don't do much. Devise a plan, be at it, and from here on, expect greater continuity. Earlier there was a problem. A fund which was a large cap fund became a mid cap fund or something. They were very loosely defined. No longer.
Okay. So you know how to pick funds post this new classification, and we are here. You can write into us, and it's now time now, Dhiren, to go on to the Q&A part of our program. We have a first question from Nagesh. As the criteria to consider a stock mid cap or small cap for mutual funds has been precisely defined by SEBI, does it mean that the investment in mid and small cap funds will now be safer than they were in the past?
No, not really. In fact, sometimes earlier it was very loosely defined. If a fund company was stating that it will be investing in small companies, everybody had their own definition. Now SEBI says that the definition of small cap is companies which are not in the top 250 companies, excluding the top 250 companies, are small caps. So you will have small caps. That does not reduce the risk. Small caps are volatile, they are risky, and if a fund manager chooses to invest in riskier small caps, smaller companies are risky, they will be more volatile. So maybe now you can, as I said earlier while discussing it, that you will have a uniform definition of small caps being followed by all funds.
It has to be within the small.
Great, yeah. So
criteria.
It will be all, not the top 250 companies. Beyond that, that's about it. That does not make it safer. Small caps and mid caps will remain more volatile. They will be more, you will see big ups and downs. Small companies, the promise of small companies that when it turns bigger, you make a lot of money. And the peril of small cap is that many companies falter. They don't turn, they disappear. They don't really make it. They don't turn big. And so selectivity will work. That does not make it safer. Yes, comparability of small caps will be higher. Earlier there were small cap funds which were actually investing in mid caps. There were mid cap funds which were investing substantially in large caps. No longer. You will have a very standard comparison and uniformity of definition being followed by fund managers.
Okay. The next question is from Deepak. Is it a good strategy to invest in two value-oriented funds?
It's a good strategy to be investing in value-oriented fund as well. And now there is a very clearly defined category of value funds. But I would say that not just two value-oriented funds. I think India is going to be a growth-oriented market. The primary reason growth investing is exciting. Value-oriented funds, they can be very disappointing at times. In a racy market, they struggle, they lag, and overall, you do well. So I would say that if I am investing for the long run, I would be investing a third of my money in a value fund and 2/3 of my money in growth funds, the standard multi-caps or the mid-caps or the large and mid-cap fund, depending on my choice. So if I have to invest 100 rupees, 66 rupees goes into growth, 33%, and this way I will actually be diversifying with strategy. These funds will actually provide me the cushion on a big decline. If you look at the fund performance in the last 1.5, 2 years, if you look at 2 years where 6-8 months of struggle, the growth funds were doing very well last year, and this year they have crumbled, and the value fund have not fallen as much because they invest in cheaper stocks, relatively lower, cheaply valued stocks. So right now the numbers look very comparable, but last year everybody was regretting that where these value funds are not going anywhere. So have exposure to these companies. They are trying to attempt to buy into stocks which are relatively cheaper, and it works, but it works with a longer time frame. I still think that growth investing is the way to go for Indians.
Well said. Kiran writes in, is there a category of funds which invests only in future and options?
There is a category, but you don't really derive the benefit. If your expectation is that here is a fund which will be able to leverage its capability of investing in derivatives to give you substantial return or superlative return, no. We have the arbitrage funds which invest in futures and they sell in the cash market. Mutual funds are prohibited from dabbling into derivatives in a manner which becomes speculative. So no, not of that kind. There are arbitrage fund which gives you a return almost like a liquid fund. So the spirit of your question, the answer is no. Technicality, yes. There are funds which invest only in futures and cash market.
Okay, we have next question from Ashish, and he writes that I have both direct shares and equity mutual funds in my portfolio with a long-term vision. Is it fine, or am I just duplicating efforts?
You are not duplicating effort. If you're trying your hand, I think be methodical about it. The only thing you should worry about is these are different ways of achieving the same results. You can invest in stocks directly. You can invest, if I go from assuming that there are investors who have to invest in equity for the next 5 years and more, then there are different paths to investing for 5 years and long-term investment, the easiest and the first step should be investing in a hybrid equity fund, 75% equity, 25% debt, and a conservative hybrid equity. The equity portfolio is managed conservative, so you get used to it and you are able to onboard or step into equity without much of a heartburn. Then comes investing in large cap fund, which is a step ahead, all equity portfolio. Then diversifying more, invest in multi caps and large and mid cap fund. Then investing in the small caps and mid caps, which could be aggressive way of investing in companies which are small, which can potentially go up substantially, and they will also be extremely volatile. Volatility is not risk. Volatility is scary, and of course the risk of the underlying companies, whether they can withstand a downturn, whether they are well managed, whether they can scale up, those standard business risk actually prevail. And then comes investing in stocks directly, where you are taking a call. So if you have the time and if you have the interest, it is a good way, but be methodical about it. Maybe just have 25% of your money, try it out for 3 years. The big advantage of investing directly in stock is that if you are enjoying it and you have all the principles, you are learning on the way. If you can diversify well, choose good companies, invest, and you have the temperament, I think these are critical elements. If you don't have this, if you don't have time, if you don't have interest, and if you are not enjoying it, if you don't have an investing temperament, choosing a company and holding it and withstanding ups and downs, then go for a mutual fund. Mutual fund provides you all kind of, and then it's a matter of scale. You should be doing all this only if you have something meaningful there. For your 2,500 rupee, it is very hard to do all that and make sense of it. And so if you are able to do all that, you will also save the expense ratio. You will also save the management fee which you incur when investing in a mutual fund. But if you have 5,000, 10,000, 50,000, and if you don't have the time, if you don't have the inclination, go with a mutual fund. They offer you substantial benefit of doing all this without much to worry about. Yes, you're duplicating effort, but it is worth attempting. I don't think they are different way. They are completely different. You are meeting the same goal more efficiently, but you should have those variables to be investing directly.
While answering this question, you mentioned, and it has kind of stayed in my mind, about volatility, that one should not be scared of it. Yep. More people are. I mean, most of us are scared of volatility. But you just mentioned that it is one should not be scared of it. It's not a risk.
Volatility is a risk if you don't have time on your side.
Okay.
Volatility is a risk if you don't know what you are doing, what you are into. If I'm in a company and because the market is a very mad place. Variety of reasons influence the market in a short term, in a very dramatic way. Right. You come across a news item, something happening in North Korea, and the market tanks by 5%.
Sentiments play a role.
That doesn't mean that, but if you are an investor, then you are investing or you are becoming the part owner of a company, where a lot of people get up in the morning to do an activity, and end of the day they make profits. And that profit, because companies make profit, markets don't. Right. And if companies make profit, the belief is that it will reflect in the stock prices. If it will reflect in the stock prices, it may not happen tomorrow. Right. It may take time, and market will take its own time to recognize that. Given this context, that is the belief, that is the promise of equity. Hold it for the long term. Companies don't disappear. There will be all kind of noise which will be distracting, and stick to it. So this temporary ups and downs, yes, if you choose a bad stock, or if you choose a fund which has a good track record of picking not so great stocks, then there is a risk. It will be choosing companies where it will be investing in companies which may not do well.
Right.
It may be a speculative fund, or your equity portfolio can be one such. So risk comes from not knowing what you're doing. If you are investing in good companies which will make profit and will not, and that is not an easy thing. You have to do a lot of groundwork, a lot of hard work to figure it out, build your belief system, not get unnerved by a 10% decline in a brief period of time. It's not easy, but it can be done.
Time, as you said, time is important. Okay, next question is quite interesting, Dhiren, and it says, does an equity fund manager have a choice not to invest for time due to market conditions? If yes, where does he park the money?
Yes, most equity fund managers have the flexibility. They have the discretion of not investing 10%, 20%, or even up to 35% of their money. And in fact, we have a multi-asset, and we have this arbitrage fund. We have this asset allocation funds where the fund manager can choose to be fully into fixed income or fully into equity, depending on the state of the market. But even all equity fund have the flexibility. And many a times they exercise that option, and where they invest in short-term bonds, because the equity fund manager's goal of investing in fixed income is not to maximize return. It is to protect the downside, the decline in value. So, or waiting for an opportunity. Sometimes the fund manager have often made a claim that they are not very enthused by the state of the market. They find the valuation of the market or the underlying companies or the kind of companies they want to buy not very cheap, and so they are waiting for a market correction, the market to fall, to buy further. So I have come across situations, where a third of the fund's money is maybe liquid, maybe in cash or debt. The debt funds, they invest fixed income in a very different way. They try to optimize return on the fixed income. So they might be so when I'm talking about aggressive equity fund, those funds invest in fixed income to generate return. They try to generate return by investing in a kind of bond which will be more than the usual short-term bonds, and they will be investing 2/3 of the money in equity. The equity fund per se, they don't maximize return. They just try to maintain liquidity and some return.
Okay. And related to this is a question by Wadia, and he says, how do fund managers maintain liquidity in their funds?
There are 2-3 levels of maintaining liquidity, 2-3 ways of maintaining liquidity. One is that, you have liquid stocks. So even the small cap funds are allowed to have, they are not supposed to be having 100%. They have the flexibility of investing 65% and remaining elsewhere. Okay. So they could be investing in, investing in liquid stocks is one. The other is that every fund is allowed to have 5 to 10%, 15% into in cash, which is short-term debt or cash. So nothing is cash as such. Even the cash there generates a little bit of return, whether it be overnight call money. And I think the principle, in a routine way, in a normal situation, the fund's liquidity is entirely met by the flows. Because if you are a fund, a lot of investors are putting their money in an open-end fund, and some investors are taking their money out. So if the net outflow from a fund is less than the inflow, if there are investors who are putting 500 rupees in a fund, and investors who are pulling their money out is only 400 rupees, so the fund manager has to do nothing about it. He is still getting 100 rupees to be invested. Fund managers have to worry about liquidity only when the outflow is more than the inflow. When you get less money and when you have to pay out more money, more investors are queuing up to take their money out. That is when you have to worry about what to sell. And for that they have the cash or the short-term debt or the liquid stocks in the portfolio. And beyond that, if there is a run on the fund, then that's a risk. Because when a fund manager is forced to sell their stocks at the inopportune time, and those are the occasions when which are not so pleasant, because most investors come in mass only when things are very bad, market is crumbling, market is falling every other day, and that is the time when the fund manager also finds it difficult to sell, and his selling only leads to bigger fall in the underlying stocks that he plans to sell. So that impacts the negative, that impacts the NAV of the fund far more substantially.
Okay. Very well explained, and that's all we have in today's program. Thank you so much for participating along with us, and thank you, Dhiren, for answering to all the queries and explaining to us about SEBI's new classification system. Till we meet next time, continue to invest and keep smiling.